You do the math. Trying to save 20% down on a starter home feels like building a tower that is designed to collapse. If you are paying rent on time every month, you have the cash flow to handle a mortgage. But if you are looking at entry-level homes between $140,000 and $170,000, your biggest hurdle isn't the monthly payment, it's the upfront cash required to finalize the purchase. There is a widespread assumption that you need $10,000, $20,000, or even $30,000 saved up to buy a house. The reality is that the actual cash you need to bring to the closing table can be closer to $1,000. This diagram compares the two scenarios on a $150,000 home. The traditional 20% down payment demands $30,000 in cash. The low cash approach drops your total out-of-pocket requirement to somewhere between $900 and $1,500. This addresses the exact trap many renters face. You can comfortably manage a $1,200 mortgage payment, but you cannot realistically stockpile a massive lump sum while simultaneously paying your landlord. Reaching that $1,000 threshold is not a loophole or a scam. It is the result of aligning specific financial tools designed precisely for this situation. The strategy relies on stacking three distinct mechanisms: an FHA loan, a 3% seller concession, and a down payment assistance program. Once you understand the math behind how these three pieces work together, buying a home stops being an abstract goal and becomes a practical checklist. The foundation of this strategy is securing an FHA mortgage. Instead of demanding the traditional 20% down, the Federal Housing Administration allows you to purchase a home with a minimum down payment of 3.5%. This chart breaks down the timeline. On a baseline $150,000 starter home, that 3.5% translates to exactly $5,250. You bypass the massive cash requirement immediately. That accessibility requires a strict trade-off. Because you are putting down less cash, the lender mandates mortgage insurance premiums. This insurance cost arrives in two parts. First, there is a 1.75% upfront fee. You do not pay this at the closing table, it gets financed directly into your base loan amount. Second, there is an annual fee of 0.55%. That amount is chopped up and added to your monthly mortgage payment. You are accepting a slightly larger total loan and a higher monthly obligation. In exchange, you preserve thousands of dollars of liquid savings. The FHA loan provides the necessary starting point, but it still leaves you facing a $5,250 down payment, plus estimated closing costs. That requires the next step in the stack. Closing costs are the hidden expense of any real estate transaction. Lender fees, title policies, and prepaying your escrows usually add another 3% to your upfront bill. You handle that additional expense using the second mechanism, negotiating a seller concession into your purchase offer. Returning to the chart, the estimated 3% closing cost on our $150,000 home is $4,500. A negotiated 3% seller concession mathematically neutralizes that cost down to zero. A seller concession is an agreement where the seller officially credits part of their proceeds back to you, specifically to cover those closing fees. The rules for this are rigid. The money can only cover actual documented closing costs and prepaid items. It cannot exceed what you owe, and any leftover money dissolves. You cannot pocket it as cash. The major trade-off of this mechanism is that it depends entirely on the current conditions of your local real estate market.
In a hyper-competitive seller's market, where a home gets multiple offers on the first day, convincing a seller to pay your closing costs is incredibly difficult. It is much more feasible in a balanced or slower market. If successfully negotiated, the concession entirely handles your closing fees, but you are still on the hook for the $5,250 down payment. That brings us to the final piece. We still have to cover that remaining 3.5% down payment without draining your bank account. The solution is a down payment assistance program offered by state housing agencies, counties, or local nonprofits. When a down payment assistance program absorbs that final hurdle, your required upfront cash drops drastically. It leaves you responsible for strictly out-of-pocket transaction fees. Depending on the specific program, this help arrives in different formats. It might be a flat grant, a forgivable loan that clears after you live in the home for a set period, or a low-interest second mortgage. Accessing these funds comes with strict eligibility trade-offs. You have to meet specific income limits, credit score minimums, and purchase a home within designated geographic boundaries. If you qualify, the final cash you need is between $900 and $1,050. That pays for 2 mandatory steps: a home inspection running $300 to $400 and a property appraisal around $600 to $650. Clearing the upfront cash barrier secures the property. The next question is what you owe every month after moving in. This stacked chart breaks down the estimated monthly payment on a $150,000 home utilizing this strategy. Principal and interest make up $907. Property taxes add $138, and homeowner's insurance adds $125. Finally, the FHA mortgage insurance adds $66. The total comes to $1,236.
Local property tax rates will drastically swing this final number. Higher tax urban areas will push the total up, while lower tax suburban counties will bring it down. By stacking an FHA loan, seller concessions, and down payment assistance, you eliminate an impossible $30,000 cash barrier, resulting in a manageable monthly payment between $1,200 and $1,500. This combination of tools works effectively, but we have to evaluate exactly who it is designed for. You must meet a 4-point criteria matrix. You need to qualify for FHA credit standards. Your household must fit within local down payment assistance income limits. You have to be shopping in a market where sellers will accept a 3% concession, and you must comfortably support a $1,200 to $1,500 monthly budget. The ideal candidate is a budget-conscious renter with steady income and decent credit, who plans to stay in the home long enough to satisfy the forgiveness terms of their assistance program. You should avoid this strategy if you are looking in fiercely competitive neighborhoods where sellers refuse concessions. It is also the wrong approach for cash-rich buyers who want to avoid FHA insurance fees entirely. All the numbers we've covered are educational estimates based on an illustrative 6.25% rate. Your actual numbers will shift based on a formal lender review, market conditions, and your specific credit profile. Stop disqualifying yourself based on the 20% down payment myth. Take this framework to a licensed local lender, secure real pre-approval data, and find out exactly what it takes to reach the closing table.